Hello! Today we will be estimating bad debts using the allowance method, based on a percentage of accounts receivable and a percentage of sales. In case you forgot or need a reminder, bad debts arise when a customer who purchased on credit ultimately is not able to pay what they promised. The fact that some customers won't be able to pay is part of the cost of doing business, and that's what we call bad debts. Now, most companies are going to estimate their bad debts, and for this reason we need a new account which is called the allowance for doubtful accounts. The balance of the allowance for doubtful accounts represents the amount of accounts receivable that the company believes it will ultimately be unable to collect. This account is a contra asset, meaning it has a normal credit balance, whereas most assets have a normal debit balance. To give an example, if the accounts receivable account had a $10,000 debit balance, and the allowance for doubtful accounts had a $100 credit balance, this would mean that the company believes that $100 out of the total $10,000 account receivable is uncollectible, leaving $9,900 as the net realizable value or collectible portion of accounts receivable. You might be wondering, why are we estimating bad debts in the first place? Well, to help you understand the concept a little better, I have created this graphic. So let's assume that in time period 1, which could be a year or a month or whatever, we have some sale to a customer on account. Then we come on to time period 2, and at that point the company determines that the sale from time period 1 is uncollectible, so it's going to be a bad debt. Well, there are a couple things the company could do. They could write off the account in this period and record bad debt expense in time period 2. We would call that the direct write-off method. But the issue with that is that it would violate the matching principle. Now, the matching principle states that expenses should be reported in the same period as the revenues they are related to. So this bad debt over here is really related to the sale in time period 1. So we'd probably want to report that expense also in time period 1. So therefore, what a company is usually going to do is they're going to estimate their bad debts in the time period of the sale. So usually at the end of that period, we're going to estimate the bad debts that are going to happen in time period 2 or even into future time periods potentially, and report that expense in time period 1. So the key takeaway is that bad debt expense should be reported in time period 1 when the sale was made and not in time period 2 to be consistent with the matching principle. So now we can go over here and we can look at an actual problem. So we are going to have 3 different situations where we are going to try to figure out the journal entry related to the allowance for doubtful accounts to estimate our bad debts. So in the first circumstance, we are to assume that the allowance for doubtful accounts had a $30 debit balance, as I'm showing over here. And we need to prepare the year-end adjusting entry to recognize bad debts, assuming that 4% of accounts receivable are estimated to be uncollectible. So we also have up here the T account for the accounts receivable. So the first step might be to calculate the 4% of accounts receivable. So if we bring up a calculator, we take 0.04 and we multiply that by the accounts receivable amount of $21,200. We see that we get $848. The next question is, what do we do with this number of $848? Notice that the company is estimating bad debts based on the accounts receivable balance. Since accounts receivable is a balance sheet account, we consider this the balance sheet approach. Now remember that the balance of the allowance for doubtful accounts reflects the amount of accounts receivable that the company believes is ultimately uncollectible. So $848 here is what we want the balance of the allowance for doubtful accounts to be. In other words, the balance of the allowance for doubtful accounts should be $848 after we've made some adjusting entry. So what we can do is we can put a balance down here of $848, and then we have to ask ourselves, what journal entry would we have to make, or how would we have to adjust the allowance for doubtful accounts to get to a balance of $848? Well, right now we have a $30 debit balance, so you can think of that as being $30 in the hole, or negative $30 for the allowance. So the way that you're going to get the adjusting entry is going to be to add these two numbers together. So if you take 848 and you add that to $30, you will get $878. So the journal entry is always going to look the same way. The debit is going to be for bad debt expense, and the credit is going to be for the allowance for doubtful accounts. And both numbers are going to be the $878 that we just found. Next, number 2 says, assume that the allowance for doubtful accounts had a $30 debit balance. Prepare the year-end adjusting entry to recognize bad debts, assuming that 0.5% of credit sales are estimated to be uncollectible. So we can take our calculator, and we take 0.5%, which is 0.005, and we can multiply that by the credit sales, which are $195,000, and that gives us a number of 975. The next question is, what do we do with this number of 975? Notice that this time the company is estimating bad debts based on credit sales, whereas last time it was based on accounts receivable. So that's actually going to change the process here slightly. Since sales is an income statement account, we consider this the income statement approach. And since sales is an income statement account, that means it's also a temporary account. So the sales number here relates to the total credit sales that were made in the current period, which was $195,000. Now, we often think of the bad debt expense as increasing proportional to the sales. So the bad debt expense should increase by $975 since that is 0.5% of sales. So in order to increase the bad debt expense by $975, that would mean that would actually have to go above the line in the T account. So that would actually have to be right here. It's not the balance of the allowance for doubtful accounts, it's how much it's increasing by when we do percentage of sales. So if you wanted to, you could also calculate the balance here. That would be 975 minus 30, which would be 945. Now we don't particularly need this number here, but I thought I would just calculate it since we are doing the T accounts. The number we really need is the $975. So we can use bad debt expense for $975 and then allowance for doubtful accounts again, and that's also for $975. So the key difference here is when you are estimating based on a percentage of accounts receivable, your calculation of the percent of accounts receivable is below the line, meaning it's the balance of the allowance for doubtful accounts. Whereas when we're doing a percentage of sales, it will be above the line. It's actually the journal entry that we're going to use for the bad debt expense. Next, in number 3, it says, assume that the allowance for doubtful accounts had a $30 credit balance. We need to prepare the year-end adjusting entry to recognize bad debts, assuming that 4% of accounts receivable are estimated to be uncollectible. Now we have the $30 credit balance reflected over here in the last T account for allowance for doubtful accounts based on number 3. So again, we can calculate the 4% of accounts receivable, but we've already done that before. The accounts receivable balance hasn't changed, and we know from before that was $848. So since we're doing percentage of accounts receivable, we know that number has to go below the line. That's going to be the balance of the allowance for doubtful accounts after we've made the adjusting entry. So we can put that down here. Now we have to ask ourselves what amount is going to have to go between the 30 and the 848 in order to get us this balance of 848. Well, if you take the 848 and you subtract $30, you will get 818. And now you'll see if you take 818 and you add 30, that will add up to $848. So if you have a credit balance for allowance for doubtful accounts, what you need to do is take the balance that you calculated and subtract what is already there to get the amount for the adjusting entry. Whereas if it was on the debit side, you actually have to add those two numbers together to get the amount for the adjusting entry. So here we can go to the journal and we can debit bad debt expense and credit allowance for doubtful accounts again. And this time it's going to be for $818. Alright, that wraps up our video for estimating the allowance for doubtful accounts based on percentage of sales and percentage of accounts receivable.